following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, everybody, welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from theoptionsinsider.com as well as the Options Insider Radio Network. And before we dive in with the rest of our panel, let me just remind you, in a couple of days, by the time you hear this will be Monday, so in a couple of days, we'll be having our premier live event, the Unusual Activity Forum. If for some reason you haven't signed up by now, then we encourage you. A couple seats left. I think they'll hopefully still be left by Monday. We'll see. But surf on over to theoptionsinsider.com/events, and you can find out more about that. In fact, if you like what we're going to talk about today, which is, of course, the book, you will get that book for free if you attend our event. So a little carrot there for all of you listening today. It's kind of a crazy deal, but c'est la vie. We threw it in just to jazz it up for you listeners of Volatility Views. And joining me on the old program, as always, the yin to my yang, what one of our listeners recently referred to as Yoda. He's none other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Always a pleasure, and I guess that I've been called worse than Yoda, so that's okay.
I think that listener is taking my dark side and light side analogy to the next logical extreme.
Don't know if I'm as old as he is yet, but today happens to be my birthday, so we're getting there.
Oh, there you go. Happy birthday, Don.
Thank you.
But I think you have about 800 some odd years to go to catch up with Yoda, I believe, if my math is correct.
Right.
All right, and we'll also be joined momentarily by good old Mark Sebastian from Option Pit. And now it's time for the Volatility Review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective, and we're pleased to be joined now by good old Mark Sebastian from OptionPit.com. Mr. Mark, welcome to the show, and what caught your eye over the past week's worth of volatility action, or perhaps a little bit of inaction?
Well, interesting. I think all the volatility is now coming from the commodities and from the Japanese yen. We're seeing something, I think, that's fascinating right now, where in the U.S. we've got the dollar gaining strength, we've got near all-time low in interest rates, and an all-time high in the stock market. And so something's got to give, and it looks like all the inflation plays are getting just pummeled over the last couple of weeks, and that play may continue.
Yeah, of course, listeners, if you're not aware, we're recording this on a Friday, and just yesterday, the dollar hit a relatively near-term historic high against the yen. The 100 yen level hasn't been there since, I believe, 2009. So quite a historic level. If you're into the currencies at all, that certainly should catch your eye and take notice for you. We don't really hit on currency vol that much here on the show.
No.
Perhaps it's something we could add to future editions as well. We kind of...
Yeah, I mean, it's just a real interesting thing. The VIX has been pretty stable. People keep asking, why isn't the VIX falling? And I keep saying, because it's hard for it to fall this low when, when 20 and 10-day realized volatility is appropriate. 10-day vol is trading at a 3.5-4% discount to the VIX. That's appropriate. So that's why the VIX isn't falling anymore.
Yes, all the people out there with the common questions about why is VIX cash going hither and yon. We could probably do a whole show just about that, and maybe we will someday. Who knows? But I think that is an interesting topic about the currency vol. We discussed it a little bit on the Options Bootcamp program yesterday, listeners. If you haven't had a chance to check that out, I recommend you go download it. I believe is actually titled Dollar versus Yen, the Eternal Struggle. So easy to find what we're talking about there. But we kind of hit on that a little bit with our guest yesterday, too, about how, for whatever reason, there still is such a vast section of the audience outside of that core institutional crowd who just haven't embraced currencies, aren't really tracked them, don't trade them that actively. There's been so many opportunities and attempts to try to get them into the fold, like the world currency options, like the FX options over at the ISC. You can put them directly into a securities account. Yep. They've all kind of failed, and it's been an interesting thing to watch.
The only ones that have had any kind of traction is like FXE and FXY, and that's about it. And even those would be marginal.
Yeah, those are marginal. We looked at FXY yesterday, and it does about 500,000 shares a day and about 12,000 options
FXY,
contracts.
It's like a crazy time in the Japanese currency. They've done 20,000 options. That's it.
Exactly. It's insane. We're living in this world now where VXX is the number 3 exchange-traded product in the world.
That is ridiculous.
And yet something like, as I would think would be much more palatable to an investing audience like currencies, can't even get traction. It's kind of weird. Don, does this cause you to scratch your brain a little bit as well, why currencies really don't translate to the masses?
Well, that we... couple of years ago brought out that euro dollar volatility product for realized volatility on CME, and for any number of reasons, including not a great deal of marketing and a huge over-the-counter presence in FX. We didn't have the success that we wanted, but you've got movement. There's no question about it. You've got it in the end. Even had some alerts on our systems about big movement in euro volatility, and yet it's hard to see the same kind of appetites that we do see in equities, for example. It's a tough market to penetrate, and it's going to be interesting to see as time goes on whether we can introduce volatility products in more than just the equities and have them catch on and have the public start to embrace volatility trading, at least on listed exchanges with some of these other assets.
Yeah, that's true. Some of our newer listeners may not be aware, but you guys have actually tilted at that windmill already with your volatility contracts on the euro over there at the CME. So you've definitely investigated that currency realm and indeed seen that difficulty of translation in that area. So an interesting topic, maybe a good topic for a future Volatility Views program. But right now, since we're in the old Vol Review, Don, what caught your eye, if anything, over the past week in NASDAQ and perhaps a little bit of commodity land out there?
Well, we didn't have Mark last week. We had him 2 weeks ago, and both of us were discussing this inversion of realized volatility being somewhat out of the ordinary, being higher than implied. And last week I spoke about the fact that we had gone a certain number of days with that type of situation, which is fairly unusual as you go to research it. Well, we're still like more than 2 weeks and going strong, and this really truly is unusual. VIX is just a couple of ticks above 13 right now, and that's a forward-looking 30-day window, and a backward-looking 21-day historical vol for S&P is still over 14, just a couple of ticks over at 14.05. That's down since our last show a week ago, and NASDAQ even more so, was about 17.8 and is now back into the very low 16s at about 16.2. So we talked about two spreads, the NASDAQ S&P spread, that's actually narrowed a little bit, but this inversion where realized volatility is still higher than VIX by at least a point or more is something that we've tried to explain, and yet it's a rather unusual phenomenon. And so question is can that continue for very much longer? If not, does it resolve by realize dropping, by VIX increasing, by a little of both? It was what I was speculating on last week, and frankly, I'm still a little bit surprised to see this inversion, this prevailing of realized over implied. It's not the usual state of affairs.
No, I think we can count on one hand the number of times that's occurred during the lifespan of the show. We know the show goes back over 2 years now. So,
is that right?
Yes, it launched in March of, I believe, 2011. So, yeah, Don and I
remember that's memories.
Don and I sitting down at the croquet courts at the Boca Raton Resort and Club at the FIA show a couple of years ago.
Time flies when you're having fun.
Yes,
huh?
Yes, indeed. So listeners, of course.
So then why does this feel so short?
Listeners, of course, you have 2 years worth of great archived episodes to check out if you've missed some of our great interviews, some of our great discussions. We have a whole series of them for your listening enjoyment. Find them on iTunes, find them on the Options Insider. You can find them on, of course, volex.us. They have a great archive there broken down by guest and topic. So a lot of great places to go if you have missed some of our earlier episodes. That's the place to do it. But of course, now we have to keep on rolling. Speaking of great guests, we have another one coming up. He is Dennis Chen, the co-author of the Options Traders Hedge Fund, and we're going to get into that right now.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, everybody, that funky tune means that it is time once again to welcome on a guest to the Volatility Views program. And today's guest is Dennis Chen. He is the co-author, along with Mark Sebastian, good old Mark Sebastian, of the Options Traders Hedge Fund. And Dennis, welcome to the program.
Thanks for having me, Mark.
And now, Dennis, it may surprise you to know this, that, Mark's a regular on the program, and yet for a number of reasons, we've never really gone into the book in that much depth and how it can really apply to our listeners here of Volatility View. So I want to get into that. I'm really excited to do that. But before we do that, because this is your first appearance on this program and indeed on our network, why don't you go ahead and give our listeners a little bit of your background in the options space and how you found your way to writing a book about options trading from a hedge fund perspective?
Sure, absolutely. I got into this business by coincidence, actually. I originally was a consultant at Bain & Company working in the financial services industries, particularly insurance. And when I left that profession, I became an entrepreneur. And eventually I had some businesses. I bought them, sold them. And at some point I got bored of doing that and wanted to take a sabbatical. So I took a year off, a sabbatical. And then on my way back to work, I figured that I really didn't want to go back to corporate America at that point. So, I said, well, what can I do? And at that point, I was investing my portfolio in equities. And I said, well, I have a lot of experience in insurance. How can I apply what I knew in insurance into the market and try to figure out how to make money as an insurance company without having all the big infrastructure of an Allstate or a State Farm? How do I do it by myself? And given that options are insurance for the financial instruments, I figured out and put together a framework to replicate an insurance company doing it, I guess, as a one-man insurance company. And that's how it got started. And then I started learning a whole bunch about how to use the options in different ways and replicate a full-blown insurance company from my computer.
So in many ways, it's the Options Traders Insurance Company as well as the Options Traders Hedge Fund in the book there.
Well, yeah. I mean, the framework is of a one-man insurance company, and eventually it became, I was trading on my own. Eventually, some friends asked me to invest money, and then I said, well, let's create a hedge fund.
Right.
And that's how it became the hedge fund.
And the Option Traders Hedge Fund does, in fact, Google search better than the one-man insurance company.
Yeah.
Yes, I'd imagine
The
so.
original title was the One Man Insurance Company, right, Mark?
Yep. That was the original title, and then they wanted us to use the word like options and traders and hedge fund, and we said, sure, why not?
And obviously, I'm pretty familiar with the book. I got to look at it before it was published, so I had a nice little treat there. But a lot of our listeners may not be. So you've given us kind of a broad overview. Why don't you walk us through some of the give our listeners a little bit of a tease of what they'll find in the book? What are some of the lessons you lay down? What are some of the broad instructions you provide to the readers?
Well, the book is broken down in three large sections. The first section is really the framework. It talks about, what is an insurance company? How does Allstate or State Farm make money? How does it map into what we're doing here with the option products? And part of the framework, it also shows the different parts of the value chain of an insurance company, which is underwriting, pricing, reinsurance, claims processing, and customer acquisition. And it shows how each of these pieces of an insurance value chain is converted into what we do as an option trader to map directly into each of these segments. So we touch on things like trade selection, risk management, trade execution, trading plan, and the infrastructure that's needed to create all this. The second area is implementing the business. Once you have the framework, then we actually go through specific chapters of once you have the framework mapped out, what do you have to do exactly to implement this, to actually execute and start selling your insurance. And the third part of the book is lessons from the trading floor. It's really like a compilation of nuggets of, wisdoms from Mark's brain.
And yours.
That's the shortest chapter, right?
Done!
That was too easy. I'm sorry.
It's we've actually had a lot of good reviews of this part 3. I mean, that's the best part of the book. So in that part, we go through lessons on volatility, things that we picked up along the way throughout, the experience we've had trading and that Mark has had trading on the floor. So that's basically the overview of the book.
So in your analogy, then the customer acquisition portion of that would be the trade selection and then so on and so forth.
Okay, no, customer acquisition is really the trading piece, actually doing the trade. When you're doing trade selection, is really underwriting. In an insurance company, say Allstate underwrites let's say car insurance, right? So they would have a specific price for, 2-door sports cars, with single male drivers. It's probably really sky high, the price for that insurance. And then they'll have another bucket, let's say soccer moms with minivans with 2 kids. They're probably a little bit less risky to insure. So they're probably the pricing in that case for the soccer mom is probably, I don't know, I'm just inventing numbers here, half the price of the insurance of the single male 25 in a two-door sports car. So that's the same thing over here. When you translate it to options, we're underwriting and you're deciding, well, am I willing to insure, I don't know, pick a name, IBM versus a Facebook that just went IPO. Let's say it was like the first week of Facebook. So there's different risk between those two markets, right? So that's the part where you select the market and you figure out what's the correct price that you're willing to sell insurance at.
And now, who in your mind is the target audience for this book? Is it very much the sweet spot of this show, the institutional audience? Is it the high-end retail trader who's really become very sophisticated from an options perspective and is now able, through account size and through complexity of their trades, to implement some of the instructions in your book? Who are you really going after with the Option Traders Hedge Fund?
Well, it's definitely both of those markets you mentioned. It's not a beginner's book by all means. I mean, you have to know a little bit about options. I mean, you need to understand the Greeks. You need to understand, how to actually, execute trades on your platform. But it's more for like the advanced
we kind
individual.
of assume that you already know the Greeks and a lot of those basics. Like every option book spends like 3 chapters explaining what the Greeks are, what the pricing model. We kind of wanted to skip that section of option books because we feel like there's overkill in that department.
Yeah, Passarelli and McMillan, those guys have that covered to a science. You don't need to go down that road again.
Right, in that order.
Yeah, you should start over there and then come over here for the second or third book.
Yeah. Natenberg. Like in our mind, read Shelley Natenberg's book and then pick up ours.
Yeah, if you're
Correct.
conversant in everything Natenberg instructs, then you should certainly be able to handle the lessons you guys are dishing out there in the Options Traders Hedge Fund. And you mentioned you start to incorporate some of the lessons of volatility in that third portion of the book. Does that pretty much just translate toward premium levels? Don't write options when the premium levels are low, or what can our listeners really expect in that volatility portion in the third portion of the book?
Mark, do you want to take that question?
Yeah, well, no, it's all about kind of relative volatility. It's not vols low, don't sell options. It's think about what you're doing when you sell options and take the time to evaluate your trades. Don't just mindlessly sell. I think more of our point is don't try and sell a bunch of premium into an up market, but it's okay to sell premium in a low vol market. I think that's kind of one of our important points.
Yeah, as long as you pick your spots, right? You have to make sure you have you're picking the right product to sell, and also that the volatility is in your favor, right?
Mm-hmm. Exactly. That's exactly right. So it's all about it's more about trying to trade for edge than it is just selling premium in many ways. It takes a premium seller's approach, but it doesn't take the mindless, I'm going to sell a condor every month approach, which is what we like.
No, and not necessarily you're selling premium all the time. Sometimes
Right.
you reverse and you're buying premium.
Mm-hmm.
You're buying vol. So it
Yep.
really depends. It really depends on the view that you have at the moment.
A very hot topic right now in the options landscape is annuities. Perhaps the sequel to the Options Traders Hedge Fund could be debunking annuities from an options trader's perspective, or something along those lines. Have you thought about that for the sequel there, Dennis?
That's an interesting idea.
That is an interesting idea.
Yeah, definitely. It could be mapped into this. Nope, they haven't given it much thought, but that's a good.
I think if we approach this again, we're gonna kind of get. What I would do is kind of almost take parts of the book. I would almost want to do a new edition of the current book, and maybe dig into a few subjects a little more than we got to in the first go round. Talk about things like offsetting a portfolio. Maybe more managing a book would be one I would want to write next.
Yeah, that part we could actually expand a lot more.
Mm-hmm.
That certainly, I know for a lot of the even those high-end retail guys are starting to face more and more of those problems as they have a growing suite of products and classes that they're managing in their own portfolios. And I think an interesting new audience for a book like this would be very much in that annuity category, of course, that new and growing audience of financial advisors who are starting to dip their toes in the options waters and realize what these products can offer them from an insurance perspective, from an income perspective, but are still very nascent in their understanding of options concepts. I think a book like this is really tailor-made in many respects for an audience like that. So I'd be curious to see how the financial advisors, as they start to come into this business more, if they start to gravitate toward this book, because it really seems to be tailor-made for them.
And it's good that you think about,
Yes.
Subsequent editions, because when you undertake something like this, publisher always wants to get it out, and you have certain deadlines, and after working with it for a very long time, you kind of get disgusted with it and say, I can't wait for this to be over. And you put out something that you can be proud of, but then you get feedback from readers. You do your own analyses of what could make this better and what might I add for another edition. that's very natural that you think that way, and you give it a little time, and then you come out with the new, improved, revised second edition, X number of pages of new material, and that's the way you build on it. So that's not bad that you think that you may have left out things that could be of interest. It's perfectly normal.
Yeah, second editions are what the book industry is built on. So keep milking those editions for as many. Edition 8, I think, is where the money really starts rolling in for these types of things.
At 8, yeah, definitely.
Well, Dennis, I'm glad we can get you on the show. I know Mark and I we've talked about it, tangentially here and there on the show over the past year or so, but we haven't really sat down and focused on what some of the lessons that this book brings to the table. And I think it would really interest a lot of the listeners of this show. You can certainly, if they want to find it, just search for the Options Traders Hedge Fund. It's right there on Amazon. You can pick it up right there. And I did tease at the top of the show, Mark has gone the extra mile for the attendees of our Unusual Activity Forum. He actually bought you a copy of the book. It's coming if you attend the show this Wednesday, you'll get a copy for your very own to page through and look at some of these lessons in more detail. But I know you just teased perhaps an upcoming revision. Anything else you want to tease our listeners or perhaps leave them with as they're thinking about clicking through to Amazon and picking up your book there, Dennis?
Well, I would more generally ask Dennis, what do you think of the current environment right now? You're a smart, active trader. Do you have any thoughts on what the market looks like right now?
Well, it's a difficult market for trading. The buy and hold guys are having a feast. For me, it's more of I get more risk averse as the market keeps going up. So I'm not selling much premium nowadays. I'm actually long volatility at this point. So it's one of the. So it's one of these environments where, I'm hesitant to sell premium, but I think the market's going up for the rest of the year. So you need to be very careful when you sell. There's one thing. Yes. For the listeners to understand. Remember, I used to live in Florida and in Miami, and there's hurricane season, right? So there will be 10 years without a significant hurricane hitting South Florida. So during those 10 years, the insurance companies start competing with each other and bringing down the prices of the insurance that you pay for to insure your house. So basically, after 10 years without a hurricane, your insurance premiums are relatively cheap to the protection that you're getting. So what happens is that at some point, a hurricane would hit. All these insurance companies that were selling really cheap premium or cheap insurance for your house gets hit. They have to pay up a whole bunch to redo South Florida, and the following year, all the premiums go up triple. Okay, that's the effect of volatility. Volatility, the following year, your premiums go through the roof, and that's when you see opportunities to selling insurance again. So basically, right now we're in the part where it's been a long time since we've seen a hurricane. Premiums are really cheap. Maybe it's worth buying the insurance now instead of selling it.
And Dennis, I'd imagine you're pretty much focused on the broad indices. Do you trade a lot of individual names or maybe even some commodities? What's your mix these days?
Pretty much, I use the broad indices, NDX, Russell, and SPX as my hedging vehicles, and I do a portfolio of about 40 to 50 individual names. So I'm trading individual names, and I'm using the indices as macro hedges.
So you're not an enthusiast of any of these volatility class of products like a VXX or a VIX option or a VIX future. You're more of a direct hedge type of guy, an S&P, SPY put spread type of thing?
Yes, correct.
That's just a little informal poll I have of all of our guests here on the Vol Views program to see what their hedging options of choice are, pun intended. Well, Dennis, like I said, I'm glad we can get you on the show. I really wanted to dive into this book for quite a while, and I wanted to just kind of give our listeners a little bit of a tease. Of course, you can find out more about this book on Amazon. Just search for the Options Traders Hedge Fund. And if they want to find out more about what you're doing, Dennis, with the hedge fund and maybe contact you with some questions about that, where can our listeners find you?
They can email me at Chen, that's D as in Dennis, CHEN, at smart-advisors.com.
Well, there you have it, listeners. You have a direct email conduit now to Dennis.
Yeah.
So you can pick his
brain.
brain.
And you know what, Mark? We actually are doing a little special at Option Pit involving the book. $30, and you get a month of Option Pit Live, and I'll send you a book as well. So a little cheaper than Amazon. But obviously, go to the best place to get it, in my opinion, Mark. Do you know where? The Unusual Activity Forum on May 15th.
I would agree. That is indeed the best place to get it, because then you get it essentially for free. It's included with everything else.
Exactly.
For that ridiculous.
But if you're not able to make it and you want a copy of the book for $30, contact my office, and we'll get you all set up.
Yeah, I'm looking here at Amazon, and it's $30 right now on Amazon. So why buy it on Amazon when you could get it from Option Pit and then get the free month of Option Pit Live as well? That's a ridiculous deal. People say our Unusual Activity Forum is a ridiculous deal, but this, sir, is a ridiculous deal as well.
It's almost as good of a deal as the Unusual Activity Forum, not quite.
That event shall go down in the annals of volatility lore as a deal for all deals. If you're not going to be in Chicago next week, listeners, you are going to miss out on something quite fun. But maybe we'll put together a nice video package so you guys can check it out after the fact. Well, Dennis, like I said, we're very glad to have you on, and I recommend all of our listeners check out the book. Like I said, I was lucky enough to check it out before it was published, and it was really some interesting stuff. And I hope our listeners all have the opportunity to do so as well. The Options Traders Hedge Fund. Either find it on Amazon or contact Mark for that better deal over at optionpit.com. And I think you're going to like what you find there.
Great. Thank you very much, Mark.
Thank you. All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to keep on rolling right on into the mailbag.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the mailbag. We only have time for a couple of questions this week, but we actually have one comment and one question. We'll start with the comment, 'cause I think it's kind of a funny one. This comes from our website, our good friend of the show here, Mr. Hawkeye. And he wrote last week, I just had to bring this up, Don. This is why I was referring to you as Yoda there at the top of the show. He writes, in honor of May the 4th, he puts in quotes, buy not, sell or sell not. There is no buy. From Don Yoda Schlesinger. Of course, May the 4th be, of course, a big Star Wars fan holiday. May the Force be with you, obviously. And he continues, thanks to all the Volatility Masters for such a great podcast. Well, you're welcome, Mr. Hawkeye. We're glad you can enjoy the show. We hope you've been listening for all these 2 years and have really gotten a lot out of it. Don, what say you to your new nickname, sir?
I've been called worse, as I said at the top of the show, so I'm sure it was meant as a compliment, and so I take it as such.
I'm sure there's a lot of crossover between our fans of this program and Star Wars fans, so I'm sure a lot of them will get something out of that. That's funny. I didn't even realize what a big thing the whole May the 4th thing is until this year when I started seeing these things popping up on the site and everything, and realizing it's this whole Star Wars movement now. So thank you for that, Mr. Hawkeye. Keep up the good work. Next up, we have a question from Mr. Todd, and he writes, I found Mark L's comment about VXX being the number 3, exchange-traded product quite surprising. You guys have slammed that product frequently on this program. Why do you think it has succeeded among the entire universe of VIX ETPs? Thanks for the great shows, Mark. When the voice of options speaks, I listen. Well, thank you for that. Mr. Todd, embracing that nickname. I tend not to embrace myself, but people seem to like it. Nonetheless, for some reason, people tend to like my voice. I don't really know why. I find it like nails on the chalkboard to me, but I guess to each their own. Mark, we talked about this on the show last week. I don't believe you were on, but of course, VXX really has achieved these ridiculously unparalleled heights for a volatility type product and even for an ETF type product. And he's right. Mr. Todd is right. We've slammed it many times on the show. It's not that great of a product. It really is pretty much a garbage product. I think Andrew called it last week predictably crappy. which is why he liked it.
Yeah, I mean, it's an awful product.
So why do you think this one of all the VIX universe has succeeded?
It's because one, people day trade the bananas out of it, and two, a lot of people don't understand it despite everything. I did 5 minutes on Bloomberg 2 weeks ago on how bad this product is, and it's just over and over and over again. You get people that don't understand it, or again, it's really popular to day trade. I know a lot of people love trading it in and out, and that's probably it.
I guess it's kind of the liquidity begets liquidity issue. Some people start trading it,
exactly,
and
right.
Others, the lemmings, follow suit. And even though it reminds me very much of USO, another quasi-popular ETF, terrible replicator of the underlying, and yet for whatever reason has a pretty strong following. Not as big as VXX, obviously, but still, for whatever reason, we slam it time and again. But there aren't really any other good alternatives at the same point. And if you're one of these, volatility, maybe you're tangentially aware of volatility. You've seen a little bit on CNBC about VIX. Maybe they've seen one of your pop-up appearances on Bloomberg or CNBC, Mark, talking about VIX and VXX, and they kind of stroke their chin and say, I want to try these volatility things.
I mean, I was on a network that will remain nameless, and somebody said, the anchor actually said, VXX is at all-time low, might be, that volatility product might be time to buy. And I had like a whole list of things I was going to discuss. I dropped everything and went along and basically said, nobody should buy this product. I had to correct the guy. I felt a little funny doing it.
It must be the old no press is bad press, or no bad press is bad, however you want to term it, because all the bad press heaped on this thing, it just continues to grow in volume. Don, what do you think? Why do you think this product has resonated with the masses so much?
I think it's primarily what Mark said. You generate an interest in volatility and VIX and in trading volatility, and for want of, there are these leveraged and inverse and what have you, but a more plain vanilla product that just claims to deliver some form of short-term volatility in an ETF, which is a popular format. It's kind of the default product. And we know all of its shortcomings, but the public isn't offered a viable or a more robust alternative. And so they flock to what's there for want of anything else. And, the concept of the liquidity and being able to get in and out just kind of fuels the gambling mentality, because although others may differ, day trading is very much a gambler's type of mentality. You don't call it investing. You call it fast money, speculating in and out, call it what you will. A lot more people think that they trade with an edge during the day than who actually do in reality, which is not to say that people don't make money day trading, but it's a small percentage of all the people who day trade. And so this product kind of fuels that desire or need, if you will. And, you can knock it for its design, and we all have, but the purveyors, I suppose, are laughing all the way to the proverbial bank, because this thing trades with an uncommon amount of liquidity.
Must be especially frustrating for someone like you, Don, who has invested so much time into creating a product that is uniquely suited to this space, and to see another product that I won't say is haphazard, because people certainly put work into that product as well, but certainly doesn't perform up to that same proverbial level of just catching fire with the masses.
Well, it is, and what you find out, I'm not teaching anybody anything, is that when you really want to make inroads into the financial markets with any kind of an innovative new instrument, it's extremely difficult, and the odds are very heavily stacked against you. And I'm not going to say that it doesn't matter what the product is, because yes, of course, you have to have an interesting and well-constructed product, but unfortunately, it's not the only thing. It's a little like the old proverbial going out to Hollywood to become an actress or a star or whatever, and it involves a great deal more than just having talent. They have to have all sorts of breaks and all sorts of luck, and have backers and have people discover you. And so bringing a product that would offer what we think is a much more robust alternative to what's out there has turned out to be a much more difficult road to hoe than we ever thought. And obviously, yes, there is a certain amount of frustration there.
It's like any other product. Financial products fall into that same category. You need to have marketing and everything else behind you. And, so these people tend to think of these financial products as something different. But you're right. The same stories, the same analogies apply in the financial realm as they do with, a bottle of dish detergent. They all have to be promoted and produced and catch on in the exact same way at the end of the day. And speaking of catching on, it's time for us to keep on rolling right on into our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball segment. This is, of course, the portion of the show where we look ahead and attempt to divine what the old volatility gods hold in store for us for the coming week. It's a difficult challenge, as you may surmise, dear listener, and I think we'll kick things off, mix it up a little bit. And Mr. Don, should I say Mr. Yoda, what's on the dark side or light side of the force for you this week, sir?
I try not to say this too often. I know we always want some sort of opinion, and so I try to not say it too often, but I really have no idea here. I think the market is looking all right and tending to go higher. And when that happens, I tend to look at inverse correlation and say that volatility still has a little bit lower to go. But having said that, we have this curious and unusual situation with VIX holding its own or even rising a little bit, even as the market continues to hit all-time highs. And we discussed this on the show last week. When you get to an all-time high, obviously it's a platitude to say you've never been there before. People have never seen this particular level. And so there can be reasons for bidding up option volatility on both sides. We're so high that we're afraid the bubble's going to burst and we're going to go much lower. People want to buy puts. We're high, but we're still going higher, so people want to jump on the bandwagon, even if it's a little bit long in the tooth, and they want to speculate on out-of-the-money calls and get the leverage effect and the lottery effect. So they bid up the price of those options also. You look on both sides, the implieds go up, and therefore VIX goes up, even though the market is going up. So it's tough to make that call as to whether or not that type of scenario will continue, in which case that traditional negative correlation between a rising market and a falling VIX just doesn't seem to hold going forward. So again, I'm going to take the fifth and say I don't really know. If you put a gun to my head, I say the market drifts higher. Realized volatility drops a little bit, and I don't have a clue as to VIX.
I think you've only taken the fifth a few times here on the show, Don, so I think we can forgive that, particularly in light of current circumstances where things are, shall we say, a bit nebulous, to be charitable. Speaking of nebulous, Mr. Sebastian, what say you for the coming week from a VIX and S&P volatility perspective, sir?
Well, we're going to see that 20-day volatility that Don was talking about drop off dramatically over the next few days because we pull some days out. When I look at where things are priced, I think they're pretty fair. We've up in the air is how does all this foreign easing affect kind of the U.S. easing? everybody keeps expecting a correction. I don't see that happening. I think we're in a situation where we're going to be in a holding pattern here for a few days, and then maybe we'll move a little higher. I think you're going to see the VIX from in the 12.5 to 14 range between now and the next time we talk. And I would say probably 13 is going to be where we're trading 12.98 as I speak. I think that's absolutely fair value.
And of course, last time we chatted, we discussed how that term structure beginning to flatten out a little bit, particularly towards the farther end of the tail.
It actually steepened. It's interesting. It's gotten a lot steeper in the last week. Now you've got May. Interestingly, May is still trading over a point premium to cash, while June is trading at like $1.25 over May. That structure has gone from flat to really steep, but trading at a huge premium to cash. It's a really weird term structure. It's like, we're bullish, but we don't trust this 13% volatility.
And, I think they may not trust the time of the year either, Mark, for those who put stock in this type of thing.
Please don't say that limerick.
Well, I'm not going to say it. I'm just telling you that we've just completed the 6 months of the year that account for virtually all of the upside of the major indices. So people see this time of the year, beginning with May and into the summertime, as a historically more challenging time for the indices. And that reflects in premium going out for the next couple of months, because it's easier for people to believe that the market may be due for a correction or do poorly during May and June than certainly during the months that we've just experienced. And therefore, with that would come supposedly or expecting higher volatility.
And before someone spouts that limerick that drives Mr. Sebastian so crazy, we shall bring it to a close.
It's sell before June to avoid the swoon.
Yes.
You know that.
Exactly.
Right?
Avoid the monsoon. I believe it originates from India. So, yes, there we go. A little factoid for you there, dear listeners. And before we go much further down this very silly rabbit hole, so we shall finally close out this crystal ball segment and also bring to a close this very interesting episode of Volatility Views. But before we go, as always, I like to check in with my cohorts, my partners in crime, to see what's coming up with them. Starting off with you, Mr. Sebastian, as we've hinted many times on this show, I believe you have a little shindig coming up by the time our listeners hear this on Monday, this week on Wednesday, where they can get a copy of your book, meet you in person, get all kinds of great stuff.
Oh, yeah. The edition of this episode you're listening to will have at least 3 things that I said that had to be cut. If you want to catch the unedited, you have to be at this event. That is one thing I would say.
Yes, our editors will have their work cut out for that. Mr. Sebastian in a live setting, perhaps no children allowed at this event.
Yeah, this is going to be, it's going to have the little adult content brand.
Sebastian, raw and uncensored.
Yes, there we go, Don. I bet you're upset you're missing it now. You should have flown in last minute just to check out all the fun. All right, so listeners, be sure to check that out. As of today, when we're recording this, there are a couple of seats left. Hopefully by Monday, they will still be available. We will be closing the rolls pretty soon. But if you haven't had a chance to get in there quick, get on over to theoptionsinsider.com, see if you can grab one of those last couple of seats before we lock it down. And speaking of locking things down, you guys have been doing actually the opposite at volex.us, adding a lot of cool stuff, including a lot of great links to our archived episodes. So if you want to go find those, that is the place to do it. Don, anything else cooking over in the land of volex.us?
Not a whole lot this past week, so we'll keep you posted.
All right, thank you for that, Mr. Schlesinger. And on behalf of Mark and Don and myself, we, of course, want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And, of course, for sending in those great questions. Keep them up, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.